Okay, so today we are going to be going over some practice exam questions for the life insurance pre-licensing exam. This could also be on the life and health pre-licensing exam, depending on your state. So we're just going to get started here. My name's Justin. Please subscribe to the channel, turn on post notifications if this helps you pass your insurance license exam. Number one, what is the main purpose of ERISA, the Employee Retirement Income Security Act of 1974? Provide retirement savings plans for self-employed individuals, to set minimum standards for pension and health plans in private industry, to establish tax-free retirement accounts, or to manage public retirement funds. The purpose of ERISA was to set minimum standards for pension and health plans in private industry. So set minimum standards for retirement plans and stuff like that. What distinguishes a defined contribution plan from other retirement plans? It offers a fixed retirement income. Benefits are based on investment performance. Annual contributions are determined by a set formula. That's the right answer. It's only available to government employees. So fixed retirement income is usually just a pension. That's a defined benefit plan, right? Pension's defined benefit plan, not defined contribution. A defined benefit and defined contribution in other plans can have underlying investments that dictate their performance, so that's not what makes it different. But it's true that annual contributions are determined by a set formula. So depending on the plan, there are different maximums that can be contributed to that plan in the formulas that are applied to it. And then obviously this is not only available to government employees. Next, which plan allows employees to share? Let me make this a little bigger. Oh, not that big. Which plan allows employees to share in the profits of a company? A 401k plan is where your employer can help contribute to your contributions. A defined benefit plan is a pension. A profit sharing plan, that's where you share in the profits of the company. A traditional IRA is anybody can set that up. You don't even have to be employed. Next, 403b plan is specifically designed for self-employed individuals. That is not true. Employees of public schools and tax-exempt organizations. That is true. 403b is for public school employees and tax-exempt organizations. It is not for corporate executives or government employees. What is a key characteristic of a KEO plan? Is it for employees of nonprofit organizations? No, that's 403b, right? Tax-exempt, nonprofit. It is for self-employed individuals and offers tax advantage. So KEO is for self-employed individuals. It exclusively invests in government bonds. That's not true. And it is a mandatory plan for all private sector employees. That is not true. So we're going to look at KEO plan. And KEO plan is qualified. It covers self-employed, qualified plans for self-employed people. It's a defined contribution plan. Yeah, okay. They're called KEO plans if they cover a self-employed individual. So it can be different plans, but essentially it's for, you just know KEO is for self-employed and there's tax advantages. Okay. Next, what feature is unique to a Roth IRA compared to a traditional IRA? Contributions are tax deductible. That is not true. Traditional IRA contributions are tax deductible. Roth IRA contributions are made after taxes. Withdrawals after 59.5 are tax-free. That is true. So since tax is already paid on the money put into a Roth, the withdrawals are tax-free. And it requires minimum or mandatory distributions after age 70.5. That's all plans. It's only available to high income earners, and that is not true. All right, so big difference between Roth and traditional is Roth you put in after tax money, traditional you put in pre-tax money. Which statement is true about the taxation of Social Security benefits? They are always exempt from federal income tax. They may be taxed if individual income exceeds certain thresholds. They are taxed at a flat rate regardless of income level, Only state taxes apply, not federal. It's B. So they may be taxed if the individual exceeds a certain threshold. What is the main feature of a simplified employee pension, SEP? It provides fixed retirement income. No, it's a defined contribution plan, not defined benefit plan. Employers contribute to an individual retirement account for each employee. That is true. Employees contribute a percentage of their salary. No, and it is not managed by the federal government. So a simplified employee pension is where employers contribute to an individual retirement account for each of their employees. Okay. In a money purchase plan, what determines the future benefits to our participant? The performance of the company's stocks, the participant's choice of investments, the total amounts contributed plus interest and dividends earned. That's it. It's not the average salary of the participant in the last 5 years, no. What is a rollover in the context of retirement plans? The reinvestment of a matured investment into the same or different investment. No. And it's an individual retirement account established with funds transferred from another retirement plan. So it's when you have a retirement account and then you just put the funds into another retirement account. It is not the act of taking a loan on the original retirement plan, and it's not converting a traditional to a Roth. 403B plan is primarily available to which of the following groups of employees? Public school employees. So we had gone over that before, but these are questions that a lot of these questions that you're going to see on your exam, they're going to be the same question, just worded in different ways. What is the primary benefit of a profit sharing plan for employees? Fixed retirement income. Participation in company's net income. That's what it is. It's profit sharing plan is you participate in the company's profits, right? Okay. If an individual aged 50 contributes $7,000 to a traditional IRA, what is the tax treatment of this contribution? So a traditional IRA is tax deductible. The contributions are, okay? So $7,000 contributed to an IRA, they are tax deductible. What is a key feature of the employee stock ownership plan? What this does, it does not provide a fixed retirement benefit. Remember, that is a defined benefit plan. It does not allow for the early withdrawal penalty to be waived. It grants employees ownership and interest in the company. Under ERISA, what is the minimum age requirement for employees to be eligible to enroll in a qualified plan? So it's 21. So 21 years old as the minimum age to enroll in a qualified plan. Okay. What happens to a Keogh plan if it includes employees other than the self-employed individual? It must include all employees on an equal basis. So Keogh plans, if it includes other employees other than the self-employed individual, must include all employees on an equal basis. In a Roth IRA, what is a qualified withdrawal? So it's withdrawal after age 59 and a half and meeting the 5-year rule. So I'm going to look up what a 5-year rule is. 5-year rule Roth IRA. 5-year rule applies to Roth IRAs as well. To qualify withdrawal, it must be 5 years since the beginning of the tax year when the original account owner made the initial contribution. So it has to be 5 years from when the original contribution was made. What is the effect of a trustee to trustee transfer in a qualified retirement plan? It avoids mandatory income tax withholding. So a trustee to trustee transfer avoids that. So we're going to look up here, trustee to trustee transfer. So you can get that. If you're getting a distribution from an IRA, you can ask the financial institution holding your IRA to make the payment directly from your IRA to another IRA. So essentially, trustee to trustee transfer is essentially when you're going from one hold one administrator of an IRA, and they send the money directly to another company that's holding an IRA or managing the IRA without having to send it to you first. So it does not result in taxation, and transfers are permitted in qualified plans. So it's like if you left a company and you had a 401k there, and you got a new company, you can transfer the money from your old company directly to the new one. What is the maximum age at which contributions to a traditional IRA can be made? So it's 70 and a half years old is the maximum contribution age to a traditional IRA. If a qualified retirement plan is found to be top heavy, what does it imply? More than 60% of assets are in key employee accounts. So if a qualified retirement plan is top heavy, that means that more than 60% of the assets in the retirement plan are in like C-suite accounts. Okay, like executives and stuff. What type of employees primarily use tax sheltered annuities? We know this, it's public school employees and certain nonprofit employees. A Keogh plan is best suited for which of the following? Self-employed individuals and unincorporated businesses. Remember that from before. Keogh plan is for self-employed. Who is eligible to participate in a traditional IRA? Anyone with earned income under age 70. So anyone with earned income under age 70 is eligible to participate in a traditional IRA. Okay. In a 401k plan, when are employee deferred contributions typically distributed penalty-free? Upon reaching age 50, upon job termination, at the attainment of age 59 and a half, or after 10 years participation. For employees covered by an employer-sponsored plan, what factor determines the deductibility of traditional IRA contributions? So it's the amount of income earned determines how much contribution can be deducted. When must traditional IRA owners start receiving payments from their accounts? At age 65. It's no later than April 1st following the year they reach age 70. So traditional IRA owners must start receiving payments from their accounts no later than April 1st following the year they reach 70 years old. Under what circumstance can a traditional IRA owner withdraw funds before age 59 and a half without a 10% penalty? So there's a couple reasons, but one is covering first-time home purchase expenses up to $10,000. What is the ideal funding vehicle for IRAs? Stocks, bonds, flexible premium deferred annuity, and real estate. It's a flexible premium deferred annuity. Skip that. That one is not right. Okay. What distinguishes a Roth IRA from a traditional IRA in terms of tax treatment? We've gone through this before. Earnings on a Roth IRA are entirely tax-free when withdrawn. Contributions are tax deductible. No, they're not. Sorry. Contributions to Roth are not tax deductible. Roth IRA distributions are taxed as ordinary income. Roth IRA requires mandatory distributions after age 70. So Roth IRA distributions are not taxed. So that's the answer right there. What is the penalty for failing to withdraw the minimum amount from a traditional IRA after reaching the required age? So 50% of the difference between the amount that should have been withdrawn and the amount that was actually withdrawn is the penalty. That's crazy. For whom is a spousal IRA designed? It's for non-working spouses of individuals with an IRA. So it's if someone's working and they have an IRA, if their spouse isn't working, the spousal IRA is designed for them. What is the feature of a conduit IRA? It is used exclusively for Roth IRA conversions. No, it's a holding tank for funds transitioning between qualified plans. So it's a place for funds to sit as they are being transferred between different qualified plans. How are qualified withdrawals from a Roth IRA taxed? They are not subject to taxation. So we're looking here. Sarah, age 45, is a self-employed graphic designer. She wants to set up a retirement plan that allows her maximum contribution flexibility. Which retirement plan is most suitable for her needs? So the Keogh plan, whenever you see self-employed, they're probably going to be referring to Keogh plans. John, an employee at a nonprofit organization. You're going to want to look for keywords in these, right? Nonprofit is associated with 403B. We went over that. John wishes to contribute to a retirement plan that allows his funds to grow tax-free until distribution. Which plan should he opt for? 403B plan. Linda, 55, participates in a profit-sharing plan at her workplace. If she decides to withdraw some funds now, what tax implications should she expect? So with this qualified plan, there is an income tax and 10% penalty. So on early withdrawals, you pay income tax and a 10% penalty. Mark, age 60, has been contributing to his 401k plan for the last 15 years. He's considering early retirement. What happens to his 401k contributions? They are distributed penalty-free. 59.5 is the earliest he can take his distributions without penalty. Emily, a teacher, wants to invest in a tax-advantaged retirement plan. She considers plans that specifically cater to public school employees. Which plan should she choose? We know this, 403B. Greg, 50, owns a small business and wants to offer a retirement plan to his employees without administrative burdens of traditional policies. A simple plan is the one where a small business owner does that to make it easy. Alice, a 58-year-old employee, wishes to make additional contributions to her retirement savings this year. Which type of plan allows for catch-up contributions? So a Roth IRA allows for catch-up contributions. You can put extra contributions into catch-up. Okay. Bob, a 62-year-old retiree, wants to transfer his retirement savings from one IRA to another without tax implications. What type of transfer should he use to avoid the mandatory income tax withholding? Do a direct rollover. And we're going to do this here. Two more. Rachel, whose husband recently passed away, inherited his IRA. She is 45 years old. What is her best option for managing these IRA benefits? Best option would be to establish a rollover in her name. Jack, 48, is considering withdrawing from his traditional IRA to fund his daughter's college education. What tax implications should he be aware of? So there won't be any tax, but he will have a 10% penalty for early withdrawal.